On March 10, 2023, the financial world watched in horror as Silicon Valley Bank disintegrated. The 16th largest bank in the United States vanished in a mere 48 hours. As depositors descended into panic and markets began to hemorrhage, a familiar sense of dread swept through the banking sector. Regional banks saw their valuations crater as investors braced for a domino effect. In the heat of the crisis, the Federal Reserve and the White House shifted into emergency mode. Yet, they didn't just consult regulators or the Big Four banks. Instead, they made a single, decisive phone call to Larry Fink, the CEO of BlackRock. When the American financial system teeters on the edge of the abyss, the government doesn't just rely on its own machinery, it calls the company that effectively operates the system's plumbing. As of early 2025, BlackRock oversees a staggering $11.5 trillion in assets. To put that in perspective, that figure dwarfs the GDP of every nation on Earth except for the United States and China. However, even that $11.5 trillion figure is somewhat modest when you consider the Aladdin system. Aladdin is BlackRock's proprietary risk management platform, and it currently monitors over $21 trillion in assets for thousands of global institutions. In total, BlackRock exerts influence over roughly $32 trillion in financial assets, representing one-third of all the financial wealth on the planet. They are the dominant shareholder in titans like Apple, Microsoft, Amazon, and Tesla, along with 18,000 other corporations. Crucially, when you invest in an index fund, you are effectively handing over your proxy. You provide the capital, but BlackRock retains the power. By purchasing these funds, the average investor surrenders their voting rights to a corporate leviathan. This concentration of power means that BlackRock, alongside Vanguard and State Street, collectively controls 20% to 25% of the shares in nearly every major American corporation. They hold the keys to the kingdom, they decide who sits on corporate boards. They dictate executive compensation packages. They approve or block mergers and acquisitions. They steer the long-term strategic direction of the global economy. And they do all of this using your money, your 401k, your pension, and your savings. This represents the greatest concentration of unelected economic power in human history. In early 2025, BlackRock began making strategic maneuvers that signal exactly what they anticipate. They aren't positioning for a period of growth, they are battening down the hatches for a crisis. In both 2008 and 2020, those who failed to read the signs were obliterated. By analyzing BlackRock's current trajectory, we can see how they profit from instability and why their latest data points suggest a significant correction is imminent. Understanding BlackRock isn't about chasing conspiracy theories, it's about observing the moves of the most powerful entity in finance. As of the final quarter of 2024, BlackRock's total assets hit the $11.5 trillion mark, up from $10 trillion just a year prior. They managed to add $1.5 trillion in a single year, largely through consistent contributions from 401k plans and retail investors. But while the total assets grew, the internal allocation shifted dramatically. In 2023, the firm held 62% of its portfolio in equities. By late 2024, that number dropped to 58%. BlackRock quietly rotated $460 billion out of the stock market. Where did that capital go? It flowed into fixed income, bonds, and cash equivalents. This is the definition of a defensive posture. You don't move $500 billion into cash and bonds unless you are bracing for high volatility or a significant market decline. While they might label this portfolio rebalancing, the timing is telling. They are selling as the S&P 500 hits all-time highs. Furthermore, in late 2024, inflows into their gold ETFs reached levels not seen since the peak of the 2020 pandemic. Over $3 billion moved into gold in just 60 days. Gold is the ultimate hedge against a fractured financial system and a weakening currency. The most alarming data point, however, comes from Aladdin. In Q4 2024, the usage of Aladdin's stress test feature surged by 47%. Major global institutions are suddenly obsessed with running simulations for market crashes and geopolitical shocks. This is not routine maintenance, it is a sign that the people managing the world's trillions are trying to calculate the depth of an impending impact. So, how does BlackRock actually make money during a catastrophe? Their business model is deceptively simple. They charge management fees. While a fee of 0.1% might seem negligible, on an $11.5 trillion base, that generates $11.5 billion in annual revenue. In 2024, the firm generated roughly $17.9 billion in total revenue and $5.5 billion in net income. The beauty of this model, for BlackRock, is that these fees are collected regardless of market performance. If the market crashes by 50%, they still collect fees on the remaining trillions. They are managing your risk, but they aren't risking their own capital. In a crisis, BlackRock's revenue actually has multiple catalysts for growth. First, the Aladdin business spikes. When panic sets in, every institution on Earth pays for access to BlackRock's risk modeling tools to find a way out of the burning building. Second, and more importantly, are the government contracts. During the 2008 collapse of Bear Stearns and AIG, the Federal Reserve realized it lacked the tools to value toxic assets. They hired BlackRock to do it for them. In 2020, when the Fed needed to stabilize the bond market, they again hired BlackRock to manage the buying program. The conflict of interest was staggering. BlackRock was advising the government on which bonds to buy, and the government ended up purchasing billions of dollars worth of BlackRock's own iShares ETFs. BlackRock essentially advised the government to buy BlackRock products. This is regulatory capture, in its purest form. For BlackRock, a crisis isn't a disaster, it's a profit center. They get paid the management fees, they get paid for the software, and they get paid by the government to manage the bailout. This influence extends into the very roof over your head. While there is a common myth that BlackRock is directly buying up every single-family home, the reality is more nuanced. While firms like Blackstone handle direct acquisitions, BlackRock acts as the primary shareholder for the companies doing the buying. BlackRock holds massive stakes in Invitation Homes, the largest single-family landlord in the U.S., and American Homes for Rent. They also own significant portions of the nation's largest homebuilders, such as D.R. Horton and Lennar. They are profit participants in the financialization of housing. By late 2024, institutional investors were purchasing nearly 18% of all single-family homes sold in the U.S. In markets like Phoenix or Atlanta, that number exceeds 25%. The result? The average American is outbid by institutional cash. Instead of building equity through a mortgage, families are forced into permanent rentals, paying 30% to 50% more in monthly costs. BlackRock profits from your inability to own property. Then there is the ESG, environmental, social, and governance, angle. Starting in 2018, Larry Fink used his annual letters to demand that CEOs adopt stakeholder capitalism. These were not mere suggestions, they were mandates. If a company didn't comply with BlackRock's vision for climate policy or social engineering, BlackRock would simply vote against their management. After facing political backlash in late 2024, BlackRock shifted its branding. They moved away from the woke terminology of ESG and rebranded it as sustainable investing or transition investing. The name changed, but the strategy did not. They continue to use their $11.5 trillion in voting power to reshape society through capital allocation rather than the democratic process. Based on BlackRock's current positioning, a clear timeline for the next 24 months emerges. 2025, Q1, Q2 * markets remain near highs, but BlackRock continues to move into defensive positions, bonds and cash, while retail investors continue to buy at the top. 2025, Q3, Q4 * a potential trigger event, be it a debt ceiling crisis or a geopolitical shock, initiates a market cascade. 2026, Q1, Q2 * the crash occurs. Markets drop 30% to 40%. BlackRock's volatility hedging products spike in value. 2026, Q3, Q4 * the government intervenes with emergency measures. BlackRock is once again hired to manage the response. 2027 * the recovery begins. BlackRock uses its massive cash reserves to buy distressed assets at the bottom, emerging more powerful than ever. If you want to survive this cycle, you must follow the playbook of the machine. 1. Rebalance your risk. Don't be 100% in equities when the largest manager in the world is at 58%. Hedge with gold. A 5% to 10% allocation provides a safety net when currencies and stocks falter. Build liquidity. You cannot buy the bottom if your cash is tied up in a crashing market. Watch the filings. If BlackRock is selling a specific sector, you should probably be exiting as well. You are already inside the machine. Your 401k and your cost of living are dictated by their decisions. The only question is whether you will be a victim of the next crisis or if you will position yourself alongside the entity that sees it coming. BlackRock isn't hiding their moves, they just aren't advertising them. They are moving quietly, shifting billions into safety and hiring restructuring experts for the bankruptcies they know are coming. In 2008 and 2020, they were ready. The only question is, will you be?